All right, let's have a look at potential adjustments. And in this video, I want to highlight not necessarily the right way, because there are many right ways to adjust a trade like a 1-1-2 bear trap. There's definitely a lot of bad ways, and the most common bad way, in my opinion, is the following. So a lot of traders look to make adjustments to their bear trap when the market is starting to push lower earlier in the trade. We're starting to approach towards the trap. We're starting to accumulate positive delta. Obviously, early on in the trade, this trade has been open for just about 8 days, and we have moved about just less than half of one standard deviation. So we're not doing anything crazy or anything that was not priced in from 8 days ago. But today, market being down about 37 points, we are moving a little bit more than what was priced in going into today. So volatility may be rising just a little bit, and the P&L is starting to turn negative. And as we push lower, the P&L is not going to get any prettier. So number one, a lot of traders right away try to escape the fact that they are going to look at some ugly P&L numbers, and they rush to make an adjustment. For me, I would not rush to make an adjustment just yet, because there are still, in this example, we have 85 days in this trade. A lot can happen. We're barely starting to enter the trap. I would prefer this happened later on in the trade, but we have to play the hand that was dealt to us. So let's talk about adjustments. As we can see here, this position is currently showing a net delta of plus 242. So one bad way a lot of traders look at adjustments, they think that they can sell something that isn't going to take up any more buying power, and they're going to cut their net delta or their directional exposure at the same time. So that feels like a good thing to do. And a lot of times what's going to happen is, let's say we're plus 240 on the delta. We wanted to dump, let's say, 200 deltas here. So the first thing most traders will reach for is to go out and sell calls or call spreads, whichever it is that's going to get us to our goal. And the goal, again, is to get rid of about positive 200 delta. So let's look at, we know that at the money options are 50 delta. So if we wanted to get rid of 200 delta here, all we have to do is sell maybe 4 of the 50 delta calls. And let's see what that looks like. So here we sell the calls, our delta, and we can look at our delta goes from plus 240 to about plus 35, or let's call it plus 40, right? So we have gotten rid of about 200 delta here. But what it did do at the same time, it also introduced upside risk. So now we can look at the T plus 0 line. On the downside, right, the blue line is my actual T plus 0 line. The green line is my adjusted T plus 0 line. So we can see that on the downside, yes, losses are going to be slightly smaller, but we still didn't fix the problem. The problem is we're trying to fix our downside problem. Our T plus 0 line is still sloping downwards if the market continues to push lower. So the problem is not fixed yet. And what we also did here is we introduced upside risk. If the market is going to bounce hard and run higher, now we have to scramble again to fix our upside problem, because if the market does go up, now we are going to start to accumulate negative delta, which we will then have to go out and try to figure out. And once again, most will look at making an adjustment such as selling something on the downside. But again, selling options in the opposite direction of where your problem is only bends your T plus 0, right? It creates it more pronounced to the downside and to the upside, but it doesn't fix the problem. In my opinion, the right way, or one of the right ways to fix this problem, is instead of selling at the money or out of the money calls or call spreads here, I need to figure out a way to lift my T+0 line. Let me see if I can draw this out and show you what that looks like. Right, so here is my T+0 line, and it's pointing downwards. What I need to do, instead of selling something on the upside, I need to figure out a way to raise my T+0, so then maybe over the next couple of weeks, right, the price, which is currently at 44.60, maybe come into the trap and then bounce around. Maybe we'll find some support, right? But all I'm doing here is I'm trying to turn my T+0 line from downward sloping to kind of flat, right? So that maybe I'll catch the price somewhere inside the trap, give it a chance to figure out whether we're going to continue lower or we're going to bounce higher. And if we do bounce higher, whatever I'm going to do on the downside, I can get rid of it. But I do not want to bend my T+0 line on the upside, because if we do bounce hard, I don't want to scramble and try to figure out how to fix my T+0 on the upside. So I think one of the right ways to do it, or an adjustment that I would prefer over selling calls or call spreads here, what I would rather do, I would look instead to maybe buy 5 of the downside puts, say at around 40 delta. Sure, it's going to cost me, right? It's going to cost me the original credit that I collected in this trade. But as you can see, I got rid of about the same amount of delta. I'm back to 36 delta here, but my T+0 on the downside is a lot better looking. Sure, I still didn't completely fix my problem because it is still downward sloping, but I can see that if we are going to continue higher, buying the puts that I'm buying are going to increase in value, and they could potentially hold up this trade together a little bit better on the downside. If I wanted to completely get rid of this problem and maybe make my T+0 much better on the downside, I would have to go further out of the money and maybe buy 8 of the 30 delta puts. As you can see, the difference between my adjusted T+0 and my real T+0 by buying out of the money or at the money puts rather than selling calls is a much better option here. And this is not a set and forget type of an adjustment. Here, we would have to continue to monitor. Maybe we come down here. We made our T+0 pretty smooth to the downside. We continue to look for support. If we do find support and we start to move back up, right? At that point, I want to figure out what to do with these puts. Maybe they had increased in value and I can sell them and fix my T+0 line. And now, if that is the case, let's say at some point in the future, we sold to close the puts that we bought as a hedge. Now that is going to increase our profit potential outside the trap. And at the same time, it saved us the heartache from watching P&L go deeper in the red by just buying some out of the money or at the money puts instead of selling calls or call spreads. So that's the idea. I'm just trying to highlight the difference between buying puts and selling calls. If you have a problem on the downside, look to buy puts instead of selling calls. If you have a problem on the upside, look to buy calls or call spreads instead of selling puts. I hope you found this useful. Until next time, trade 'em well.